American Pacific Mortgage is a multi-state corporation supported by mortgage professionals who live and work here in the Treasure Valley. The office is at 8921 Hackmore Drive, just off South Maple Grove. American Pacific Mortgage treats you as an individual, not a number. They are a local equal housing lender with underwriters who know the area. Finding the right loan for you is the goal. They have a wide range of loan products: FHA, VA, refinance, home equity, and reverse mortgages for seniors. More on the web at thelendingsspot.com or phone 629-4959, NMLS number 1850.
And now, your friend in the real estate business, John Adamson.
Hello, and welcome to another edition of Property Line Today. My name is Curtis Mangus, and I'll be your host for today's show. Today, we're going to talk about the home loan process, both before you apply for a home loan and during the process as well. And with me today as co-host, I have Sandy Gregston from American Pacific Mortgage, my associate. Welcome, Sandy.
Thank you. Glad to be here.
Sandy has 34 years of experience in the mortgage business. I only have 31, but between the two of us, we have 65 years of home loan experience. And today we're going to share with you the process, the things you need to know, and the things you need to be aware of to help make the home loan process smoother when it comes time to apply for a home loan. First of all, Sandy, if you would kind of explain some of the general things people need to know when they are getting ready to apply for a home loan.
You bet. I think we talk often about making sure that your stuff is accurate, your documentation is accurate, in that you want to make sure that you're not going to be paying anything off early, making sure that your payments are going to be accurate, as far as no new accounts, unless you've spoken to us previously about that. Oftentimes we find that folks go out and charge things, maybe have too much debt, and then they come to us and unfortunately it's already been done, the damage.
Very true. Very often what we find with people is they sometimes will decide that they want to buy a home impulsively, and they haven't thought through the process, and there's some things that they could have done ahead of time and been a little bit more proactive that would have made the process easier on us and consequently easier on them. Some of the normal examples we'll have is we'll see somebody who have purchased a new car 30 days before they apply for a home loan, which is a really bad idea.
Yes.
Because very often a new car purchase and the inquiries from the credit could perhaps drop their score 30 to 50 points.
Often.
And so we unfortunately are having the conversations about, well, we hope you enjoy sleeping in the back of that pickup truck because unfortunately you did it backwards and you purchased the car, then the house, when it should have been the other way around. And so one of the things we would really suggest for people is if you're going to buy a home, think about it. If you can, plan a little bit in advance, do a little bit of research so that you understand what needs to be done, which is part of the reason why we're doing the show today, so it can help better prepare people to understand what they need to do so that the home process goes much better. One of the things that's important for people to know is we look back 60 days on everybody's finances. And what that means is we're getting 60 days worth of bank statements, we're going to get 30 to 60 days worth of payroll check stubs, and we're going to go through those bank statements with a fine-tooth comb, not only to show the income that's going in there, but also anything that's unusual in the way of deposits, cash deposits and unusual deposits are a constant problem for us as lenders because they're an indication that there's something else going on out there other than a person's regular payroll that needs to be addressed. If you could explain some of the typical scenarios that we see for deposits.
You bet. Once in a while we'll see very large deposits and we can't track them because the customer has indicated they are cash. So of course we want to make sure that if you're going to deposit anything, it might be a good idea to let us know first. That way we can stave off anything that might be uncomfortable for the customer because we don't want that. We want a good smooth process, and part of that is when we have to delve into their finances, they get a little touchy, and they should. You know, it's very personal and private information, but we cannot allow blackened statements. So if you black out anything, it kind of lets us know that you might be hiding something, even though you're not and you don't intend to. So we want to make sure that you are going to be okay when you go through underwriting. That's the main process that we have is, if everything goes through underwriting and it's smooth, you're going to be a happy camper when it comes to getting that mortgage.
Well, and another example on bank statements is very often people's bank statements may be 5 or 6 pages long, and if it says page 1 of 6, we need all 6 pages. And quite often people will not give us page 6 and we'll get it and it'll say this page intentionally left blank, but we still have to have it. Another issue that we often have with bank statements, people will pull them off the internet and they don't realize it, but it doesn't have their name and or account number on it, and we can't tell whose they are.
Indeed.
And so literally when we're asking for these type of things, the attention to detail has to be there because underwriters are looking for all of these things. They've got to be able to identify all pages on a bank statement. They've got to be able to tell perfectly whose they are. If there's any unusual deposits, they have to be explained. And people are often asking us, why do you have to know about deposits? And first of all, the main reason is if there's a $2,000 deposit that's not your payroll and it's unusual, then of course in our world the first thing we think of is that you've borrowed money somewhere and it's an unusually large payment and it's going to cause you to default on your home loan. So they have to document where it came from to make sure they know what it is as well as what it isn't. And very often I'll explain to people that I say, we have to make sure that you're not robbing banks, selling drugs, committing a felony, borrowing money that is going to cause you to default. All of those things have to be explained and proven, and that's part of the reason why if you know that up front, it'll help the product.
Indeed.
Help the system.
Indeed.
What else do we need to talk about that we often see?
Well, I think we see quite often, especially if you're in the industry of a truck driver, perhaps someone that receives a lot of W-2s. You may work for the union. And what we see on your tax returns is what they call a 2106 expense. And what that is you're getting a nice tax deduction because you've written off your uniforms, license fees, which we do often as well. And what that's called is unreimbursed expenses because your employer does not reimburse you for those. So you get to write them off. Well, guess what happens when you come to us for a loan? And it could be upwards of $20,000 for, let's say, 13 and 14, years 13 and 14. We take an average of 24 months, and that can be substantial, and it's deducted from your income, and all of a sudden, you don't qualify. And we just have to stop and tell you that right at that time, and it's not very pleasant, I have to tell you.
Well, and another thing that we often scrutinize that we have to see is people's payroll check stubs. And people will do an application and they'll indicate their income and debts on an application. But of course, you can't tell everything from a home loan application. As an example, you can't see child support, and very often customers won't disclose it to us, even though it is a monthly payment or obligation. And we won't see that until it shows up on somebody's payroll check stub in underwriting or early on in the process. And we're wondering what that $200 every 2 weeks is. It's coming out of somebody's payroll check stub. We have to include that as a payment or a debt, and that can make a difference in what people qualify for or if they qualify at all. And so that's an example of some of the things that we can't necessarily see initially on an application. Another thing is if people are borrowing money out of their IRA and 401k. Some loan products force us to be able to count that as a payment, conventional mainly. Most of the government loan products do not, and so those are the kind of things that we have to look at that can be discovered, later on in the process that can cause us a problem from a debt ratio perspective.
Correct.
How about commission and overtime?
Those are real interesting, and we love that. I love anyone that's in the restaurant business that perhaps is a server. As you know, they are paid mainly on their tips, so everybody make sure you tip them well next time you eat out. So typically what we want to do is you're going to take a base pay, it could be $3.35 an hour, and then you're going to use tips. So we use accumulation and a year to date and usually the past 2 years. Those have to be a 2-year history. So if anyone is in the commission business selling cars, furniture sales, restaurant, server, those we want to consider and use a year to date plus the past 2 years to use, for their income. That can be very frustrating for folks because when they say I get $2,000 a month, we may only be able to use
$1,000.
$1,000, and it's very difficult because they know they get it, but we just can't provide the evidence.
One of the things we like to point out to customers is you may in the last 6 months have been making $2,000 a month, which is perfectly fine. The problem is when we average 24 months and we average it out, you may only be making $1,000 based on the average. And so we look back 2 years for typically commission income, quite often overtime, bonus income, and we're going to average that for 2 years. And people, of course, are often only thinking the last 6 months, maybe 12 months, and what they've made, because of course that's what they're making recently, and of course we want them to improve. But underwriting standards typically will force us or require us to average those things over a 2-year period. And so the problem is, of course, when we average it, it may not be representative of what they currently make. And so just because a customer makes the income now doesn't mean, one, that we can count it at all, or if we can count it, that it won't be necessarily representative of their income recently because of the income averaging. Is that correct?
Yes.
And what about self-employed clients? Typically, what do we require for that?
Well, self-employed clients, you're going to look at 2 years employment federal tax returns. Typically, we're going to look at a Schedule C. Most people have Schedule C, sole proprietor type of income. And always look at line 31. And I always tell folks that if you look at your line 31, tell me if that's a positive or a negative. Because if that's a negative, in the last 2 years it's been negative, there's going to be probably an issue unless you have a lot of depreciation that we can use.
Because that's typically about the only thing we can
That's about all
add
you can
back.
add back in. The other thing you can add back in on self-employed is if you work from home. So we have some of that, that we can add back in, and you can use that as well, and it does help the bottom line.
So for self-employed borrowers, what we like to let people know is we have to use an average of the last 2 years' tax returns. Unfortunately, in most underwriting with income, they're using worst case. There might be 3 different ways that income can be figured, but they're typically going to use the worst case scenario when figuring income, not the best case. And the problem with self-employed people and people that we have to go off of tax returns in general is a CPA's job, a tax preparer's job, is to minimize your taxable income, which makes perfect sense for the IRS, but is a problem when you're dealing with people like us. Because if they minimize, of course, what your taxable income is, it might be low enough that it forces or causes you not to be able to qualify. And so those are always things, if you're self-employed and thinking about buying a home in the next year, you need to take a close look at what your tax returns are, and I would suggest you even talk to your lender before your next year's tax return is filed so that you know how much income you need to report to make sure that you'll qualify. Because unfortunately, we all the time will see people that their CPA has done too good of a job and written off too many of the things that they legally can do, and unfortunately in the end it makes it so that they can't qualify. And just because you're paying rent of $1,000 a month, if your tax returns don't support that $1,000 a month, you're unfortunately probably not going to be able to qualify for a loan.
True.
How about new employment?
New employment's always a challenge for us. We like to have at least 30 days of probation because oftentimes you're going to see in your contracts from your employer that they're going to stipulate a 30-day probation period. What we like to see is we're going to send out what they call an employment verification. And from that, your employer will fill out all the boxes that we've asked them to complete. And part of that is if they're hourly, how many hours do they work? Okay, so if they work 40 hours and their pay stub supports that, then that is what we're going to use. It's really quite helpful. The other thing that we're going to ask our customers and have them be prepared is oftentimes they have a salary key code. And many employers right now are going to what they call the work number, Curtis. You're aware of that. So it is very helpful if you know your employer uses the work number to verify employment. If you can go to the work number, there is a format, and we have an email that we can send to you that you can actually input to get what they call a salary key code. It's 6 digits. So if that helps you, it would greatly help out. It takes us about 6 seconds, I think, to get that information. And it's quite helpful in determining what your income is. And oftentimes it's income plus it tells us your date of employment. So we would appreciate that if you're going to any lender and getting and needing the verification done right away.
And just so you know what the guideline is that we generally work with employment, we are required to have a 2-year work history. That means we have to look back 2 years. That does not mean you have to have 2 years on your current job. We close people all the time with 30 to 60 days on the job that they have. So they have to have a 2-year work history, but we don't have to have 2 years on the current job. And we'll often talk to customers with a few months on the job and they don't think that they'll qualify. But that verification of employment that Sandy just talked about is, as long as it says that you're a full-time permanent employee, and that's the key to the whole thing, and that your probationary period is over, and some probationary periods can typically go from 30 to 90 days, and so it has to be past whatever that is, and as long as that verification says that you're full-time permanent, 40 hours a week or whatever it is, and of course your payroll check stubs match. Unfortunately, if there's a discrepancy, then an underwriter is going to catch that, and it has to be addressed. And so that's the key, just to let you know, is that we need a 2-year work history, but we don't need 2 years on the current job. We often can get by with just 2 or 3 months, as long, especially if there's continuity in the work. We can also count college as work history, so we're able to help college students who graduate from college as an engineer. To give you an example, they get a job as an engineer. We only need 30 days on the job, full-time permanent status, payroll check stubs, in order to be able to close them on a home loan. So in some of those things, people are making it harder than it really is. And so it's important that people understand what those guidelines are, because unfortunately some people are waiting or thinking that they need to wait until they have a year on the job or something like that, when it's really not necessary. Let's talk about credit card balances for a minute.
Don't pay them off. We go through this often, where a customer will need to qualify for the loan, and they go and they pay their credit cards off, and then if they don't have a home and they may not close for 90 days, we re-pull the credit, and then all of a sudden the credit score has dropped significantly because they went out and paid credit cards off, or they've increased them. There could be multiple reasons why it dropped, and sometimes it increases, but I think we find the other more than we find it increased.
One of the things that's very important that people don't understand, it's true, people just don't understand credit scores and how they work. And it's so important, literally right now, knowledge is power, especially when it comes with credit. And we see people all the time, they don't mean to, but they actually are doing self-destructive behavior with the things that they do. And unfortunately, maxing out a credit card will drop your score significantly. And unfortunately, also paying a credit card off can also drop the score quite a bit. When we're rescoring people or helping people with their credit, and we work with this every day, the credit score analyzers tell us to pay it down to $25. It's funny, you don't want to pay it off for whatever reason. That's harder on your score. It's important to keep a small running balance in order to maintain your credit score, or if you're trying to build a credit score, and many people don't know or realize that. Another thing, of course, that is a mistake is don't close accounts. Because one of the things a credit scoring model does, it looks back at history, and if you've closed an account, it may eliminate that history, and it could have a significant impact on your score. We talked about car loans. One of the most common problems that we see with people is they'll go buy a new car a month, 2-3 months before they apply for a home loan, and they've done that backwards. And what they don't realize is they could have 5 to 10 inquiries on their credit, because very often a car dealership may shop or send that customer to 5 or 10 different finance companies, and that can affect somebody's credit score 30 to 50 points as well. And so the key here that we're trying to explain to people as my father would say, proceed with caution, be careful, don't do something rash like go out and buy a car a month or 2 or 3 before you want to buy a house, because it could have a really negative impact on your credit or your debt ratio, and consequently your ability to qualify for a home loan. Would you
That's
agree?
correct. Yes.
And unfortunately, we see this a lot because people haven't planned and they don't have the foresight to look out a few months. And so we would also encourage you, if you're seriously thinking about a home loan, check your credit. All right, see what's on there. Annualcreditreport.com is an excellent place to go and pull a copy of a report just to make sure that things are accurate, up to date. Things that are supposed to be paid off are. If you've had any negative credit, it shows a zero balance or has been taken care of. And that should be done 2 to 3 months before you apply, because if something needs corrected, it takes time.
It does take time, yes.
And then there are also places you can go and get a copy of your credit score. I know Discover Card sends out, I'm not sure how accurate it is, but sends out a score. Invariably, people will go to Credit Karma. And I hate to tell you this, Credit Karma is not very accurate. For whatever reason, I'll typically see a 20 to 30 point drop in score from what people will pull off of Credit Karma and what we will pull for somebody's home loan. One of the reasons is Credit Karma typically is one score. And in the mortgage business, we pull all 3 credit bureaus and throw out the high and low, and we use the middle. Invariably, I'm sure Credit Karma must pull the high.
The high.
And we end up pulling the middle, and so sometimes people are disappointed, and I can assure you it's not our fault. We want your score to be as high as it possibly can because it makes the qualification process better. But the more homework you can do ahead of time in the process in order to help us help you, the smoother the process will go for you when it actually becomes time to apply. And if you're not sure, talk to your lender. We'll have people apply 3 months ahead of time, and so that if we have any issues, it gives us time to work through them.
Correct.
Let's talk about, got to have credit to get credit.
You do. You would think you do. However, there are a few programs that will allow us to use what they call alternative credit. And alternative credit is simply a source of alternation as far as your rent history for 12 months, power, gas, telephone bill, anything else that you would pay on a monthly basis, we will utilize and get copies of statements. And I've had some, I guess it was insurance, they actually wrote a letter and said this customer pays their premiums on time and never has missed a date. So that is very helpful if we can use it, but not all programs in our industry will allow alternative credit. They want you to have a credit score.
Yeah, and that's alternative credit is for people who just don't have any credit. It doesn't replace a poor credit score. It helps replace no credit score. And so we would always encourage people, it is true, general rule is if you got to have credit to get credit, whether you get a secured credit card, open up a store charge, get a small car loan, you need some kind of financing, typically a year or 2 ahead of time. Ideally, we like 3 accounts open and active on a credit report for at least 12 months. It helps if one of those is a credit card from the scoring models. And so look ahead a little bit, especially if you're younger. If you're in your early 20s, if you can open up 2 or 3 accounts and pay on them for a while, and they don't need to be large. It doesn't have to, a $25 payment is just as good as a $250 payment when it comes to credit history. The key is that you just need to have some so that the credit reports, 1, know that you're there, and 2, that you've demonstrated responsible credit behavior over time. And invariably, we will have people that will tell us, well, I wasn't very smart when I was younger, or I didn't pay very good attention. And I've got really bad news. Credit reports are very unforgiving. If you make a mistake and you have late payments or you have collections, they'll stay on your credit for 7 years. They will haunt you for years. It is so much easier to just open up some small accounts and make sure that you pay them, because being young and irresponsible is not an excuse to a credit scoring model. It does not help. And once they're on there, they're there to stay if they're accurate, and they're very hard to replace, and it typically takes time. So we really encourage you to, one, make your payments on time, establish good credit, and pay attention to your credit report, because that way we are so much easier to get along with
Absolutely.
when the time comes.
Yes.
Along those lines, we would much rather have somebody with good credit than somebody with 20% down and bad credit.
Correct.
Because unfortunately, if you've got below a 620 credit score and you have 20% down, in our world, you're what we refer to as a renter. You cannot buy, you cannot qualify. In the good old days before 2008, you would pay a little higher interest rate, put a little bit more money down. Unfortunately, in these day and age, you just don't get the loan. And so there's nothing better than good credit. We can work around low down payment and no down payment. But one thing that often takes much more time is if somebody has a low credit score, it can take a year or two or longer in order to be able to get that up, when we can often finance somebody right away if they've just made their payments.
Correct.
Would you talk a little bit about Idaho being a community property state?
Well, as far as Idaho goes, if you are married and you want to get a loan, then you have to also have your spouse's credit report run. And the unfortunate part about that is if your spouse has a lot of debt, that could really hinder you getting a loan approval. One reason that you wouldn't have your spouse on the loan, or he wouldn't have you on the loan, is because of credit. You don't have a good credit score or good enough credit score to do the loan. So then what we want to do is qualify you a loan on the credit, and then your spouse becomes what they call a non-borrowing spouse. They occupy the residence, and then at that time of closing, they just quit claim their interest of the home to you. And it's a pretty simple process, but unfortunately, one of you don't get to be on the loan. That's kind of how that works.
Right.
Yeah.
And so what Sandy and I were trying to do here in the first half of the show today is just to explain that you need to pay careful attention to your credit, make sure you've established some good credit, make your payments, pay attention to your bank statements, no unusual deposits. Use some foresight here if you're planning on buying a home. Be proactive with, one, deposits into your account, making your payments on time, being careful with how you manage your finances. Don't buy a new car a few months before. Be very careful about retail therapy and a lot of charge accounts before you're wanting to buy a home, because all of those things unfortunately could cause you trouble later. And so use some foresight, be proactive, be responsible, and the home loan process will go so much better for you. And we're going to take a short break, and then when we come back, we're going to talk about the things you need to pay attention to once you have a home under contract and the process after that. Thank you. We'll be right back. Hello, and we're back for the second part of Property Line today. In this part of the show, we're going to talk about the actual home loan process and what that entails once somebody has decided to actually purchase a home. A normal scenario for Sandy and I is typically I'll get contacted from a potential client to buy or refinance. I'll spend a few minutes with them to make sure initially that it sounds like they'll qualify. And I'll typically have them do an online application, because they can do that on my website in typically about 15 minutes. It's a nice, easy, user-friendly way for people to get their initial information to me from home. When that's completed, I can pull that into our home loan origination software, pull their credit report, and I do an initial evaluation to make sure that it looks like credit and income are going to meet typical home loan standards. At that point in time, I'll give them a call, kind of go over the broad overview of the basics of the loan. If there's any glaring questions on credit or income, down payment, loan product, that kind of thing, we'll typically address those up front so that we have everybody is on the same page and has a good idea and a direction of where we're going from there. At that point in time, I'll go ahead and have Sandy, my associate, get involved. And Sandy, if you kind of explain from there your side of what what
You bet.
happens.
What we want to do is make our application as complete as possible. And by doing that, we want to send the customer an initial list so that they can provide us with their W-2s for 2 years, their tax returns so that we can accurately make sure that they don't have any businesses that we're not aware of. Current pay stubs are, paramount for us to make sure that we have correct income and we calculated it right. The worst thing we can do is go forward with a loan and then get the pay stubs and we don't have a deal, because we've had that happen once in a while when somebody said they made $3,000 and they really made $1,000. So the other thing we always want to get is some kind of a photo ID. If you don't drive, that's okay. It could be your passport or anything else that is a picture of you. And the other items, I think if you're divorced and we need to verify child support, then of course we're going to get that as well. And that is, by the way, included in your ratios. If you have child support, that is going to be continuing. So I think we have about 3 years that we're going to look to make sure that if you're going to have a child that's you're probably supporting and they're about 14, you probably are going to have that for another 3 years at least in
So
most cases.
the good news is if you're collecting child support, we can use it as income if it's going to continue for 3 years out. So in other words, if the child is younger than 15, we can typically use it for income. The downside is if you're paying it, we're going to hold it against you no matter how long you're paying it. Even if it's 3 to 6 months, typically we're going to hold that against you most of the time, even as a debt. And child support is one of those things, typically we have to document it with some kind of divorce decree or child support order.
Correct.
What other things are we looking for typically once we've done the initial application? What else are you asking for besides payroll check stubs, W-2s, divorce decree?
Well, in the initial process, when customers don't have a property yet, then what we want to do is obtain this information quickly so that we can run it through underwriting. And I think that is the foremost reason that we do so well and we don't have fallouts, because we do run every customer we have through our underwriting process so that it's smooth. And then go shop. It's so nice to be able to call a customer and say, thank you, all we need is a contract, and go shop.
And so I would certainly suggest that you get pre-approved ahead of time. It's not a difficult process. It sometimes takes a little bit of time. Somebody who has 800 credit scores and 20% down is very easy. Somebody who has a lower credit score and little or no money, of course, that is more on the borderline, sometimes takes a little bit longer. But I can assure you that is time well spent up front, because one, you understand, how much you can buy, what your payments are going to be. And if you're going to purchase a home on typically a 30-year loan, you want to be as thorough as you can up front so that you don't have any surprises, and we don't either. Because in the home loan business, surprises are always a very bad thing.
Yes.
And we will occasionally have something sneak up on us, but we try, with 65 years of experience, most of the time we can see something up front and see it coming to where we can help the customer and make sure that it's something that we can take care of. So that the process goes more smoothly. And then once you have a home under contract, typically the first thing that is done once you have an accepted offer is a home inspection. And what a home inspection is something that typically the real estate agent will order for the buyer. And a home inspector will go through the property with, quote, a fine-tooth comb. They'll typically spend several hours there, take lots of pictures. They'll go right down to the point of looking in the attic, the crawl space, the roof, leaky faucets, insulation. They go through the entire property looking for any minor and major issues that might arise, because of course the idea is that when you're buying a home, you want that property in good condition so that you don't have any unforeseen repairs, and of course the lender wants that as well. And if there is something that is found, one of my favorite sayings is, home inspector's job is to make sure that there's not a swimming pool in the crawl space, that you don't have an attic full of mold or water, any unusual repairs, settling, foundation issues, major and minor things. They want you to be aware of all those things, because if you're going to spend $150,000, $200,000 on a property and have it financed for 30 years, of course everybody wants to make sure that you're buying a home in good condition. So a home inspector, his job is strictly with condition. All right, that is his job, is to go over it and make sure that the property is in good condition. And then if the inspection comes back favorably, or the seller says if there are any major repairs that they'll be fixed. Sandy, if you would explain then what is entailed with the appraisal process.
Well, the appraisal process is, once we receive it, then we will send the customer a copy of the appraisal along with an acknowledgement. And nowadays, we're required, before we can even draw the documents for your loan, we're required to have you sign that you did indeed receive the appraisal. So once that appraisal acknowledgement form comes back signed, then we proceed with, actually, you're almost home at that time. You know, you're almost finished. And so we will proceed to draw your documents once everything's in. But usually the appraisal is the last thing that comes in most cases.
Usually an appraisal is right at the end. And a home inspection is ordered typically by the real estate agent. An appraisal is typically ordered by the lender. And when the appraisal is ordered, an appraiser's job is different from a home inspector's job. There's a little bit of overlap there, but the appraiser is primarily concerned with value. He is going to inspect the property to make sure it's in reasonable condition, but he does not go into nearly the detail of that a home inspector does. And so what an appraiser will do, he will walk through the house, he will measure it, he will check square footage, he will check overall condition. And then he is going to look at other properties in the neighborhood that have sold recently, ideally within the last 3 to 6 months, and he's going to compare your subject property that you're buying with other homes that have recently sold, and he's going to look at what they call those comparable sales, and he's going to justify the value of the purchase price against those other comparable sales to make sure that he can justify to the lender and to you as the buyer that that property is really worth what you're paying for. And usually they do.
Yes, they do.
But occasionally they will come in short. If for some reason the seller has the property listed too high based on the other comparable sales, then the appraiser may come in short, and we hate it when that happens.
Yes, we do.
Because obviously at that point in time we have a serious issue, because of course, one, the lender is not going to let the buyer purchase a property for over the price, and of course, why would a buyer want to buy a house for more than it's actually worth? Most of the time at that point, the seller will come down to whatever the appraised value is, because that's actually what it is worth. But we do occasionally have a seller who won't agree, and the deal will actually fall after the inspection and the appraisal happens. And it's unfortunate, but it does occasionally happen. And so once the home loan is approved, you get a house under contract. You'll have the home inspection done. If it comes back satisfactory, we will then order the appraisal. We always have the home inspection done first, because if they find something that is a, quote, deal breaker, and it's not something that the buyer and the seller can resolve, then often the transaction will stop right then. We don't want to have an appraisal done until we know that, because the only thing worse than spending $200 or $300 on a home inspection is spending another $500 on an appraisal for a property that you can't or won't buy. And so those are kind of generally the steps in the process that we take as far as with the home inspection and the appraisal. It's very important in the home loan process that you understand the different steps involved. So spend some time with your lender. That's one of the reasons, especially if you're a first-time home buyer or you haven't bought very many properties, you want to be able to sit down with a lender, go through the process, and make sure you specifically understand the steps, the payments, the process, all of that, because there are a lot of working and moving parts in the home loan process, not only from the lender's side with the underwriting side, but also with the home inspection and with the appraisal as well. And not to mention that you've of course got title work that needs to be done as well. You have a title company involved that will coordinate the process to make sure that all the liens get paid off on the property. They will also coordinate the closing, handle the transfer of funds and money back and forth, so that when it's called an escrow account is open, which basically handles all of the funds in the process, at what's called the close of escrow, which is really the loan closing, that all of the money changes hands correctly. They coordinate all that in the end all the liens get paid off. and that the seller who owned the property gets conveyed off, and that the buyer ends up owning the property with the only lien being the lender's lien. And then they will issue what's called title insurance, and it's an actual form of insurance that guarantees that the lender and the buyer are in first position and that they own the property. And so there are a lot of moving parts in a home loan process. It's not overly complicated, but there are a number of different steps involved, and it's obviously important that you work with a real estate agent and a lender, ideally locally, that can help you understand all of that, because you don't spend $150,000 or $200,000 very often, and of course we want to make sure that you do it right. Sandy, if you explain just a little bit about home insurance and what's required.
Yes, homeowners insurance is going to be insurance that you will provide the lender, and it's going to be typically on the value of your home. So what will take place is you'll give us whoever you're going to be using, name of insurance company and agent, and we will, after we receive the appraisal, we will forward that appraisal to them so that they can get an idea of what is incorporated into your home. And by that, then they'll usually give you an estimate on the premium. So that's going to be a yearly premium, whether it's $400 a year. We divide that into 12 months, and that will go into your, what they call your escrow or impound account. And that's along generally with your taxes, and sometimes mortgage insurance, I guess, if you would have that. So just know that that is also at the last, and that's usually about the week before we close your loan. So a lot of times we'll hear, well, how come nobody's contacted my insurance agent yet? And this is usually in the first 2 weeks of the loan after you've got a contract. It's like, well, we're not quite ready yet. But so I think patience is really a virtue in this process. It is to be patient, but it also is to be thorough. And that is our job, is to be thorough with you and with your finances. It's a very tender kind of thing for customers, and we want to make sure that we are protecting you.
And something on the underwriting process, of course, all loans have to be underwritten. They go through an automated process, and they actually have a physical underwriter go through and review it as well. And it's very important. We do as much as we can up front, of course, to make sure we get everything we can, but underwriters, of course, have to justify their existence as well, and they will always come back with some things that they want. And it's very important for customers to be responsive and thorough, that when we ask for something, typically we need it within 24 to 48 hours. Whatever we ask for, we want you to provide all of it, so that we can send it back through underwriting again and keep your loan progressing. Because quite often a file will go through underwriting 3 or 4 times.
Possibly.
By the time the file gets to the end, to the point that we want it to close, it'll go through an initial underwrite. Very often they'll come back with another set of conditions. We may send it through again while the appraisal is being ordered, so that when it comes back a third time, we're getting ready to send the appraisal in, the insurance binder, often those final conditions. And all of those things, one, take time. A normal home loan takes between 30 and 45 days. I saw a statistic a while back. Nationally, the average home loan closes in 45 days, and that's a national average. Typically, we see them a little quicker than that, depending on, of course, what the issues are. But there's some things we can't see. If we get the appraisal done and they come back and they call for repairs, cracked and peeling paint, might need a new roof. The home inspector may have noted it, but just to let you know, the lender typically does not see the home inspection. And so just because if it's something that you're willing to ignore as a buyer on the home inspection, depending on what it is, especially on government loans, they don't want cracked and peeling paint, unusually worn carpets, an older roof. All of those things could be called out. If those things need repaired, they could delay your closing. And so we need customers to be patient. We also need them to be responsive, and of course we want them to understand the process so that we can get them done in a timely manner. And of course what's most important to all of us is that a happy, successful conclusion with, of course, closing on time, which is, of course, because very often the seller may be moving out, the buyer might even be selling another property. There's quite often quite a bit of coordination that's going on with utilities and moving trucks and taking time off. And so we're unfortunately surprised at how often customers may not be responsive when we're asking them for conditions and needs of the loan that unfortunately can slow down the process that could possibly endanger the home loan closing on time. And if that is in danger of happening, then of course there's all kinds of other issues that has to be addressed, because of course then you've got a seller questioning why it's not closing on time. If you would explain how an escrow works.
Sure, as far as impounds go, most often when you put less than 20% down, your lender is going to require you to include in your monthly payments your taxes, your insurance, and mortgage insurance. And there is one other fee that you're never going to see into your impounds, and that's your homeowners association dues. Those are fees that we're going to look at and we're going to qualify you with, but they will never be included in your monthly payment. You will pay those directly to your homeowners association. So what I would say about that is some folks don't want that in their payments, and I will tell you this, that there's only one association that I'm aware of, Idaho Housing and Finance, will not allow you to not escrow. So you have to escrow regardless, even if you put 20% down with them. So for a customer putting 20% or more down, typically you don't have to impound for your taxes. You can pay them on your own, which some people want to do. They want to be in charge of paying their own taxes and insurance. But
Most customers prefer to have an escrow, because the nice thing about it is when you make a monthly payment, 1/12 of your property taxes, 1/12 of your homeowner's insurance gets set aside. It's basically just a savings account that's included in your payment. So when those things come due, you've already budgeted them in. You take 1/12 of that, put it in basically an escrow account or an impound account. They're the same thing. It's basically just a savings account that your lender holds. And they then when your property taxes come due every 6 months in Idaho, they're paid. And when your homeowner's insurance come due, typically once a year, it's paid. And the buyer customer doesn't have to worry about setting money aside, because unfortunately the second half of those property taxes in Idaho are due in December. Merry Christmas. And so it's nice if that's already been set aside, so you don't have to worry about making, up that 6 months worth of property taxes at a very bad time. And so there's nothing wrong with an escrow account or an impound account. Most customers prefer them. Most lenders, if you don't have 20% down, will require it. And as she said, Idaho Housing requires it regardless. But it's not a bad thing. It's actually a nice, easy way to go. I prefer it. And most customers do, because it's a nice, convenient way to make sure that those things get paid. And the lender likes it because they know it'll get paid as well, because unfortunately some people, if they don't have an escrow, they don't pay their taxes or their insurance. And the old saying goes, if you want to get somebody excited, skip a couple payments. If you want to get somebody excited, skip paying your homeowner's insurance, skip paying your property taxes, and the lender will call your note due. Because they're not adequately protected. So I can encourage most people to just go ahead and have an escrow account. It just makes the entire process much easier. And on underwriting, all right, when an underwriter reviews tax returns or bank statements or payroll check stubs, and they do look at them closely because of what's happened with the last great recession and 2008, everything in the mortgage world is scrutinized closely, and very often they'll ask for a bank statement. We'll send it in and they will condition our conditions, as we'll say. They'll come back and say, well, what about this, or what about those that large deposit, or what exactly is this on the payroll check stub. I recently had a customer object because they had an undisclosed address on their credit report and they hadn't lived there in 20 years. And unfortunately, they go through a credit report with a fine-tooth comb as well. And if there's an address on there that doesn't show on the application, they want an explanation of what that is. And that's just part of being thorough. They want to make sure that you don't own another property that hasn't been disclosed. They want to make sure that property was sold so there's not another payment or anything out there. And so even though it didn't show a date, it did show an address, and even though it was 20 years old, the underwriter still wanted to know where that property address came from, and a letter of explanation quite often will need to be written explaining anything from delinquent child support to late payments to undisclosed addresses. Any number of things will have to be explained, and as our underwriter favorite saying is, however, an explanation is not documentation. Just because you've explained it doesn't mean necessarily, sometimes that will take care of the problem, sometimes they will ask for additional documentation. To give you an example, on an undisclosed address, they could ask for a copy of the closing statement to show that that property was actually sold. Thankfully, in this case, they haven't asked for that, but quite often they will, especially if there's a mortgage that's still showing open or recently perhaps paid on a credit bureau report. And so what we'd like to point out is, in the process, be patient with us. Typically, we will get the loan done. It can be meticulous at times with the things that they're asking for and the things that they want. You have to be patient, you have to be persistent, you have to be punctual, and provide us with the things we need so that we can get your loan closed on time. Wouldn't you agree?
Correct.
And unfortunately, those are quite often some of the problems and objections that we encounter with people that can cause us, to have problems later. One last thing that we like to talk about is, don't worry if you don't have a down payment. Okay, please. A down payment is actually one of the last concerns that we have. Really, is where your money is going to come from. We're much more concerned with credit and income first. We have low down and no down payment loan programs with really good interest rates that will work for almost everybody. And so we're much more concerned with credit scores and income qualifying than we are with down payments. So don't think that you need 5 or 10% down in the bank before you can apply, because you don't. And often a problem we have is, very often on loans, especially with first-time home buyers, we will have gifts from parents. And we do not need that money in the bank up front. As a matter of fact, we encourage people to not have the parents transfer the money, because there's a very specific protocol
Correct.
that's required in order to be able to document those funds. Sandy, would you explain?
You bet. What we'd like to do is, if you're going to have a gift and you come in and you tell Curtis or myself that my family's going to give me $20,000, then what we're going to do is have you just hold right there, don't do anything, and then when we're ready for you, we're going to say, okay, now we would like you to go ahead, and what I suggest, and it's easiest, is to have your family member just do a cashier's check payable to the title company. And you just take it right into title, and it's so much cleaner than trying to document and verify where the funds came from, because oftentimes they will give you the funds and then you wait. And that's kind of what we're seeing. Oh, you wait. And then, I've got to have a payment, evidence of payment withdrawn, because you do have to have that. So you want to have something from your donor that shows that they withdrew the money in the amount of your cashier's check. And if they give you $20,000 and you bring in a check for $10,000, that's going to be a big problem. We need to have it dollar for dollar. So $20,000 gift, $20,000 cashier's check at closing. And it must state who the remitter is. It has to have your name on it. And typically they like to have the bank match everything. So just make sure that those funds match your donors.
Very good. So as you can see, it's not rocket science. There is a process involved in it. It is a very consistent process. There's a very clear protocol involved in the home loan process. With Sandy and I, after you've done it a couple thousand times, it does get easier. After doing it for 30 years, you do have a much better handle on it. I would certainly encourage anybody, if they're interested in a home loan, it certainly helps to do something local with somebody you can sit down with, reach them on the phone, to help you through the process. It can be daunting for people at the beginning just because they don't understand the process, which is part of the reason why we do these shows, is so that people have a better understanding. And then, unfortunately for the people out there that for whatever reason don't currently credit qualify, I want to spend a couple minutes just on typical credit mistakes that we see or run across with credit. One is, people are just afraid to have lenders pull their credit. A normal inquiry is 3 to 5 points. Please, the earlier you can apply, the better off you're going to be, either one, because you know things are okay, or two, if there's any issues that need to be addressed. They can often take 30, 60, 90 days or longer in order to be fixed, repaired, updated, rescored, whatever it may be. So don't wait till the last minute. The more proactive you can be with the home loan process, working on your credit, the better off it's going to be. And if you need credit repair, you can do it yourself. We would typically recommend that you don't do it yourself unless it's something fairly minor in nature that needs to be fixed. I help people with suggestions all the time, but there are some professional credit repair companies out there that do a very good job, and it's all that they would do. And so if you know your credit isn't good enough to buy a home loan right now, the worst thing you can do is nothing. Don't ignore it. Find out exactly what you need to do. You're more than welcome to call us or email us over here, and we can help you with the steps you need to go ahead and get started on credit repair, credit rehabilitation. We work with lots of people for 1, 2, 3 years in order to be able to get their credit up. So if you want to buy a house and you know your credit's not where it needs to be proactive with it. Go on to annualcreditreport.com, get a copy of your report. Just even Google credit scoring or those kind of things and get to work on it, because quite often 1 or 2 years down the road, credit can be repaired. Just the way scores go down, they can also be brought up. And finally, if you have collections, don't pay them off. Talk to your lender first, because paying off collections can actually lower your score in the short term. And so let a lender help you early on so that they can help you buy a home and make sure that you do things the right way. Sandy, thank you for coming today.
Thank you for having me.
This will wrap up another edition of Property Line Today. Thank you for watching.
American Pacific Mortgage is a multi-state corporation supported by mortgage professionals who live and work here in the Treasure Valley. The office is at 8921 Hackmore Drive, just off South Maple Grove. American Pacific Mortgage treats you as an individual, not a number. They are a local equal housing lender with underwriters who know the area. Finding the right loan for you is the goal. They have a wide range of loan products: FHA, VA, refinance, home equity, and reverse mortgages for seniors. More on the web at thelendingsspot.com or phone 629-4959, NMLS number 1850.